Hey guys, welcome to Wealth Street, where we elevate you. If you are looking for ways you can start investing with as much as $1,000, stick around until the end of this video because we will be discussing exactly how you can do that. Well, it took the world's most famous investor, Warren Buffett, 55 years to join the Billionaires Club. Some people like Jay Walker literally did it in less than a year. Jay Walker launched Priceline.com during the dot-com bubble, and his net worth instantly jumped from zero to billions. But even though that sounds exciting, it wasn't sustainable. Because once the bubble burst, it also meant Jay's net worth, along with many other billionaires' net worth, crashed. Warren Buffett is still on top of the list, and he doesn't seem to be going anywhere anytime soon. And that is the kind of wealth you want to build because it is sustainable. The game of money isn't easy. It's tough, competitive, and ruthless. And if you don't know the rules, you are doomed to fail. You see, the problem with most people is that they might work hard their entire lives, but end up poor at the end of their journey because they don't know how to let their money make even more money. In other words, they don't know how to invest. Let's assume you have been saving money and have an extra $1,000 in your bank account.
That is an achievement because nearly 70% of Americans don't even have an extra $1,000 in their bank account.
So instead of spending it on another useless gadget or a pair of shoes you'll never wear once, keep in your wardrobe for many years before you throw it away, let's assume you're going to invest that money. But the question is, how do you invest your first $1,000? Do you invest it in real estate or the stock market? What kinds of stock do you buy? Is $1,000 enough to start investing? We are going to answer all these questions and many more in this video. Go ahead and give this video a thumbs up, hit the subscribe button, and let's get started. To understand what investing is and how it works, consider this example. Let's say you worked so hard and saved $300,000. You can pay a visit to the Ferrari dealer, get yourself a luxurious car, let everyone know how successful you are, or you can buy real estate, such as a house, and rent it out. Every month, you could receive up to $2,000. If you decide you no longer want to keep receiving that $2,000 paycheck every month, you can sell it and get back your initial investment. In fact, the value of your investment might even appreciate, so you will sell it for a higher price. And that's how money makes money. But you can't buy real estate for $1,000. That's not even enough for a down payment. However, you can invest that $1,000 elsewhere and let it grow. The easiest way to grow your money would be to deposit it into a savings account and generate interest. But why would the bank pay you for keeping your money in the bank? Shouldn't they charge you instead? The bank is going to borrow your money and loan it to someone else at a higher rate, and they pay you a portion of that rate as compensation for allowing them to borrow your money. That's how banks work, in short. The only problem with this strategy is that the interest on the deposit account is so low that it might be not worth it at all for you. The highest rate you probably can get is 0.8%. That means that if you invest that $1,000 into a savings account, 12 months from now you will receive an extra $8, which is extremely low because the Fed targets an inflation rate of 2 to 3%, which means if you are not getting at least 2 to 3% from your bank, over time the real value of your $1,000 will depreciate, which means you can buy less goods with it every year. But why are interest rates so low on deposit accounts? Because interest rates in general are low. Sometimes, depending on the economic situation, such as a recession, the Fed will lower interest rates to encourage everyone to borrow money and spend. But once the recession is over, the Fed will increase interest rates to 1, 2, or 3%. This means interest rates on savings accounts will also rise. Your second option is to buy government bonds. A government bond is a security that is issued by the government to raise money to support government spending. Say the government wants to build a school, but it doesn't have the money to do that. So it issues an IOU, a piece of paper that says that whoever owns the security is owed this much amount of money, plus interest by the government. Of course, this is an oversimplified example, but that is the point. Keep in mind that government bonds are heavily influenced by interest rates. So if interest rates are extremely low, government bond rates can go as low as less than 1%. But as interest rates increase, government bonds go higher too, mostly 2 or 3%, which is not bad considering government bonds are the safest investments you can ever make. Any investment carries with it a certain level of risk. If you are loaning money to the U.S. government, what are the chances that the U.S. government will default on that loan? For the U.S. government to go bankrupt, the entire U.S. economy might have to fail. That's why U.S. bonds are considered the safest investments in the world. But if you want to make a higher return, let's say 10, 20, or 30%, you have to consider investing in the stock market. For example, Amazon's stock price increased by 80% just this year. Google's stock price by almost 30%. Tesla's stock increased 721%. Yes, you heard that right. 721%. Then the question is, why would anyone invest elsewhere when you can double or triple your money in the stock market? The answer is risk. When it comes to government bonds, for example, there isn't much risk. In fact, it is risk-free to a certain extent.
But when it comes to individual companies, there is risk.
The risk that the company might fail, it might report negative earnings, and pretty much any negative news can drive the stock price down. The company might release a product, and if the public doesn't like it, that can make some negative headlines, which can drive the price down. So the higher returns come with more risk. Apple is a well-established company, and its chances to fail are way lower than Tesla. But it also has less room to grow than Tesla. That's why Tesla grew by 721% this year, but Apple just grew 70%. What you have to determine for yourself is how much risk you can take without going nuts. If that $1,000 is all you have left, maybe risking it all isn't the wisest option. Because if things turn south, you can end up losing most of it. Another way investors minimize their risk in the stock market is by investing in an index. No one does better than the market, on average. So an index fund gives you a chunk of the market. The most famous one is the S&P 500, which tracks the top 500 US companies. Some of these companies will definitely fail, but others will grow. Judging by the historical data, the average return rate for the S&P 500 since the 1920s was around 10%. This means that buying a share of these index funds means you are buying a tiny share of the top 500 US companies. All of them are great and invest in pretty much the exact same companies. But how do you buy shares in these index funds? I mean, where do you start? First, you need to find a broker, someone that is qualified to sell you stocks. In the past, you had to pick up your phone and call a guy and ask him to sell you some shares. Remember the Wolf on Wall Street? That's what we're talking about here. He would spend his entire day calling people and trying to sell them worthless stocks. But thank God we're in 2022, and things are much better and easier.
Brokerage firms have created apps.
So you can buy shares from the comfort of your smartphone, such as Robinhood, Webull, and so on. All you have to do is download one of these apps and sign up. You can start investing right away. And that's it for today, friends. I hope you enjoyed this video and found the insights helpful. Make sure to give it a thumbs up, and if you are new to this channel, hit the subscribe button.
Turn on the notification bell
beside it so that you can be the first to see any new video. Thanks for watching. Until next time, this is Wealth Street.